Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away. So be sure to act real quick there to get the best deal. All right, back to the show. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is Luke Gromen, president and founder of Forest for the Trees. Luke, it's been a while since you've been on Forward Guidance, so it's great to have you back. How's it going?
It's great to be back. I'm doing well. It's just enjoying spring finally breaking here in lovely Cleveland, Ohio. So
love it. And yeah, hopefully you had a restful weekend because we are recording on the Monday, and to say the least, every day you show back up to markets on the start of the week. There's just endless things to talk about. So yeah, we're recording here a few hours after we got some meaningful developments in terms of the trade deal from China and what is occurring there. So overall, the way I see it is that the Chinese government and the U.S., led by Treasury Secretary Scott Bessent and Trade Representative Jameson Greer, seem to have nabbed out a 90-day pause, where the effective tariffs on the U.S. side of things are going to be 10% plus a 20% for the fentanyl side of things, netting them out at 30% for the next 90 days. And on the China side of things, we're seeing them at 10%. And they've created a framework of sorts to be able to meaningfully negotiate, because effectively when tariffs were as high as they were above 100%, we were basically in an embargo and things were starting to look pretty sketchy. So I would love to just get the high level analysis of what were your main takeaways from what you heard today from everybody.
overall, I think it's still pretty early to tell for sure. I mean, for me, I think there's a couple key takeaways, which are they are who we thought they were on the US side, which is to say, our view is that this was going to create treasury market dysfunction pretty quickly. It did. And as soon as it did, we saw the US soften its stance. And that's not to say the Chinese weren't feeling quite a bit of pain themselves, because I think they were. But ultimately, as I look out from here going forward, I don't see how you get some sort of deal that doesn't feature a much stronger Chinese yuan against a much weaker US dollar, which is kind of interesting, because it's kind of we're seeing, well, the yuan is strengthening against the dollar day, but the dollar is strengthening against the euro and the yen, the primary components of the DXY. So we're seeing a stronger dollar against them. We're seeing a weaker dollar against the yuan. Weaker dollar against the yuan, I think, is ultimately where this all nets out. But I think we were shown that we don't have a lot of staying power in any sort of deal. That the treasury market will again dysfunction very quickly, and just like Yellen and just like Biden, they will respond very quickly to treasury market dysfunctioning, which, it's really hard to be a tough guy in negotiations when I've equated it in the past that the treasury market amounts to badly broken ribs for an MMA fighter. And you might be the best puncher in the world, but you got badly broken ribs, and the other guy knows what he's doing a little bit. You're not going to be able to just stay in there and trade punches. You're going to have to, be a little bit more tactical. So it's still very early to tell. Let's see from here, but it's risk on, and as it stands right now, in my opinion.
Yeah, I'd love to dig in deeper to really understand where you think the constraints are in terms of the strategic imperatives, especially from the China side. You've had some really interesting analysis there on some of their more high-level goals there. But it was really interesting to me to hear Treasury Secretary Scott Bessent talk about how, they don't want to fully decouple from China, but there is some strategic imperatives that they want to focus on, where they want to have a more robust independence in terms of, steel, pharmaceuticals, semiconductors, et cetera. So in terms of what you heard so far today, it sounds like you still believe that there's some form of a decoupling that needs to occur. And what does that really look like on the Chinese side as well? Because you have some really interesting insights on that side as well that I don't think have been heard enough.
Something that has been I've had a hard time figuring out in my own mind as I've watched this situation transpire over the last, probably 3.5, 4 months now. I guess they were, maybe just short of 4 months since they were inaugurated, has been the amount of contradictions in the U.S. policy, which is we want to decouple, but like we don't want to all the way decouple, right? We want to get pregnant, we don't want to be all the way pregnant. We want to decouple, but we don't want to have treasury market dysfunction. We want to have dollars recycled into America, but we want to make everything here too. We want oil at 50 so that we get 10-year yields down, but we also want to produce a lot of oil. And so there's been a lot of things they've been saying which are nonsensical. They're contradictory. They can have one or the other. They can't have their cake and eat it too. And that's one of these, which is this, to me, when Bessent says something like that, he's far too smart a man to actually believe it. And so then I go, okay, what's he really mean? What is he covering for? Because the fundamental dynamic of the China-US trade relationship, of the US's position in the world, is we export dollars, we export treasuries, we export financial assets, and we import stuff. That's it. And so if we don't want to export ownership of our assets, and it was great when it was treasuries only, right? That's just basically sending away magic tokens that we can create out of thin air in return for real stuff. It stops getting quite as funny when it's, hey, here's shares of Apple, here's control of our ports, here's farmland. These are real for real. And so when we hear strategic decoupling, I keep going back to the same thing that I've been saying for 3-4 years, which is we can reshore. And if we do, the real value of the US Treasury market must be crushed. Yield curve control, capital controls, and go. Or we can kind of continue, the status quo where within 5 to 10 years, China's going to make most of our military equipment for us, with which we're surrounding them. So when I hear Bessent say that, he knows that. He absolutely knows what I just laid out. So what's he really saying? I don't know. To me, it suggests that there is a dog that doesn't bark in this whole discussion today, which is there's some sort of FX deal restructuring of the monetary system component. And who knows? It's purely speculative on my part. But when I just look at what he's saying and knowing how smart he is, I have to believe he's stupid, like galactically stupid to take at face value what he's saying. And we know he's not galactically stupid. So there's something else there. Ultimately, I think we'll get some version of, basically a much weaker dollar, yield curve if we want to reinvest in this country. Let's see.
To your point about, saying one thing but doing another, and especially when there is that dissonance, another thing I heard from Treasury Secretary Scott Bessent is he mentioned that most of the discussions in those talks over the past weekend were about the balance of trade. There were no discussions about currency accords of the like. But to your point, we're seeing the yuan strengthen. We're seeing bond yields surge today as well. There's some interesting correlations that are happening there. So what is it about the currency side of things that you feel like that's where the big game is at hand? And to your point, do you feel like that's something that they actually talked about, or is that just coming down next? And, we just have to hash out the high level terms of trade first, get that settled with, and then move on to the currency side of things.
Look, balance of trade is currency, right? It's not that America is not competitive. It's just that America is not competitive at 7.2 against the yuan, 5.2 against the yuan, 4.2 against the yuan. America's probably pretty competitive, maybe 3.2. I don't know. That's kind of like one of those things where I hear Bessent say that. It's maybe he's being cute, maybe he's being disingenuous, maybe he just does not want to say the word, I'm going to devalue the dollar. Or something that can be construed as such. But if he's talking about balance of trade, he's talking about the dollar versus the yuan cross rate, full stop. Something I've posted on X a couple different times. People say, well, we need to worry about the balance of trade. Well, China ran a $900 billion surplus, goods surplus with the world last year. China imported 1,384 tons of gold last year. If you price gold properly, China runs a flat balance of trade. If you take that as 1,384 tons of gold, put it at $22,000 an ounce. That's all right. China's now running balanced trade. Now, where would the dollar trade today if gold was at $22,000 an ounce? Probably quite a bit lower. And that's the fundamental issue of like this dissonance of we want to have our cake, we want to eat it too. My interpretation of him saying, we want a stronger dollar system and a weaker dollar, and those two things are not mutually exclusive, as he's said a couple times in the past, dating back 6 to 12 months. That's some sort of deal that if you're settling more in some sort of neutral asset where you're as the pivot point to meaningfully weakening the dollar against the yuan, that's something that could work. But again, that's a huge change, and I don't think that's something he would dare talk about. But balance, and until it's announced, right? But balance of trade is currencies, full stop. Like that's the only, like that's the lever. That's the lever.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. I want to bring in gold into this dynamic as well. It's interesting to see its reaction to this trade deal where it's just been taken out to the woodshed of sorts today, but it feels, I'd be curious your thoughts if that's mostly just, the speculative capital that moved in on terms of some sort of fear of US dollar hegemony decreasing. And, now that speculative capital is being, churned through the real game at hand. Do you still believe the real game at hand is one, this idea of the yuan being devalued against gold? And then within that framework as well, do you think there's that side of things on the US side as well? I know you've mentioned how it was really interesting to you that gold was exempted from tariffs. And so would love to just hear, do you think that was an important point to some of these negotiations here? And how does that all play out in terms of where gold sits within that framework?
Yeah, I think it's getting sold off on a, Johnny come lately traders selling it off on okay, well, there's not going to be something very short term. I think it's the absolute wrong thing to do if you look out more than, sort of very short term. Ultimately, I kind of keep coming back to the same thing, which is if the US wants to run a flatter balance of trade, the reality is the Chinese are way more productive than we are, and it's not even close. And part of the reason they're way more productive than we are is they're investing way more into robotics, productivity, et cetera. I mean, I was seeing an article in a couple months ago where they have a factory. They don't even have to have electricity in the factory because it's all robots and they know how to make in the dark and they know the movements. And so they just produce this stuff literally with robots in the dark. And it's an example, it's Chinese. So you've seen the investment in robotics. Point is that means we cannot compete unless we either significantly invest in robotics, which you're going to need to do, and to do that, oh, by the way, a lot of those robotics will probably have to come from China or maybe Japan or maybe South Korea. But again, it's likely to be inflationary if you are investing significantly in property, plant, and equipment in this country, particularly given the labor situation here, which is already tight, and the lack of skills because we've spent 40 years focusing on financialization rather than skilled trades. And so the only the lever to balance that fact that they're more productive than we are is currency. It means the dollar's got to go down a lot against the yuan. And that's tricky because that's inflationary. And if that's inflationary, that's also a problem for the bond market. And so you kind of keep coming back to this, the elephant in the room is that the bond market is the constraint. The Treasury market is the constraint. And the sooner they want to keep pretending that it's not, and sort of, putting band-aids on it. They're just better off just sort of amputating, yield curve control, capital controls, devalue the dollar, go. And so, is that what they're discussing? I don't know. Probably not. I don't know that they want to be that drastic, but I think that's why Besant keeps sounding this cognitive dissonant points, which is that it's the constraint. He can't really do much without hurting the treasury market either way. Deflation hurts the treasury market. Inflation hurts the treasury market. Will they let it? They can't take pain for more than a week or two in the treasury market. So like they might as well just like get it out of the way. But
yeah, I do want to dig a bit further into the bond market as the leading constraint in a second, but I do want to better unpack. Obviously, everybody and their mothers know that the goal now is to narrow the current account deficit with China and to recalibrate the capital account, because basically the main flow has been we give a bunch of treasuries out to China. Now, what is also interesting from the press conference that President Trump mentioned this morning is that he said that China was keen to open up their market to the US. And so I start to think about the idea that, okay, if we start to try to get, actually like US goods into China, not just treasuries, do you see that as a meaningful rebalancer to that terms of trade? And what did you think about that overall of this opening the market?
no, I don't think. I mean, I think about it and go, okay, what are we going to send the Chinese that don't have a bunch of Chinese components in it, and that the Chinese aren't, we going to send them weapons? No. We going to send them AI chips? We've already told them we're not going to do that. So, like, pretty much everything else, I don't know. Like, if you X out defense, if you X out AI chips and some of our leading edge, cutting edge technology, which I don't think we're going to send for national security reasons, what else is there that the Chinese don't make for us or make better than us or both? And I don't know what that is. I mean, part of me thinks that's part of the reason for the trade war in the first place. Like, I think there's a national defense imperative side, which is, we're borrowing money from China to build weapons face down China using Chinese components. This has to stop. And I think the Defense Department's been pushing for that for a while. But I think more recently, there's been an aspect of the trade war where corporate America is waking up. The blue chip, untouchables in America are waking up and going, oh my God, we're losing. And not only are we losing in China, soon we're going to be losing elsewhere around the world. And it's fascinating to hear these execs talk the way, my union leader, late father-in-law, talked about the Chinese 20 years ago. Oof, we're losing. We can't compete with this. So I think part of the reason corporate America has been sort of okay with tariffs and some of this is they see themselves losing, right? Like Tesla's losing, BYD. Apple's losing massive share in China. It's only a matter of time till they start losing share outside of China to Huawei and others. And so when you have these national champions on the US side, DeepSeek was a perfect example. America thought it was winning in open AI, et cetera. And all of a sudden it was like, whoa, wait, what? And so we've kind of seen this over and over and over. I saw this 20 years ago in sort of the, when we followed construction equipment at a firm that I worked at in my former life. It was like, oh, this Chinese stuff is crap and it's never going to overtake Caterpillar. And then all of a sudden it's like, well, 5 years later, they're kicking out Caterpillar stuff. And I don't even remember if it was Cat or not specific, but the point is that they were replacing US brands with domestic made brands. And did they probably steal the IP? Yeah. Like, grow up. How stupid are you? You sent the stuff there. And I had a conversation with someone recently where they're like, well, they have taken our IP over and over and over and over and over. I'm like, okay, after the first or second over, like, who's the idiot? Why did you keep sending stuff there? And it's either greed, naivete, or stupidity. Which one is it? And it's really a combination of all three. So I think I hear, yeah, we're going to send stuff there. Like, the reason they're there in the first place is because China was going to be this huge market for American companies. And so to me, it's just like, are we really going to recycle that one again of like, hey, China's going to be a great growth market for Western companies? I'm like, we tried that. Like, what's the only difference now is the Chinese stuff is way better than it was 20 years ago when that was going to be true too. So to me, when you sort of take a step back from that and go, that's nonsense, unless the dollar is absolutely hammered so that the American stuff is super cheap and that opens the door. Otherwise, like the Chinese, like the stuff that Chinese will want, the Americans aren't going to sell. And again, to me, it points back to a neutral reserve asset of gold, right? Or, hey, fine, we'll settle in gold, but if we're going to do that with the deficits we're running, it's going to have to be at a much higher price, or we'll run out.
It feels to me like you are still in the camp of, it feels like we are going in, we're at peak globalization, and now we're going to head into a world where we have the US as the core economy, and then the countries that associate with the US, and then China, and then the countries over there that associate with China and trade there. Do you still believe that that's the eventuality, that even though they don't want to say we don't want to fully decouple, just when you play out the game theory like you just did right there, that's where we're headed regardless?
Yeah, I mean, I think everybody has some level of fear, real or imagined, of an inability to compete with China. And we frequently hear, China is they're just overproducing. It's just a factory. It's who was it, Besant or Lutnick or somebody said it was like the dance of the brooms in Disney, right? Where Mickey's got the brooms and there's one broom creates a new broom, the wizard thing. That's true. And it's also a perfectly rational response to what the US side has been, which is the opposite side of the same coin, which is just creating dollars, creating debt, creating debt, creating debt. So I think there is a peak globalization. I think we're going to re-regionalize. I think you're seeing that. I think certain Asian economies have real concerns around China and their ability to compete with China. I think ultimately you're going to just see those countries trade more with each other. And, I think the US, will probably try to sign deals with South Korea and Japan to try to sort of reshore. The setup is is reminiscent in some ways of 1945, except opposite. In other words, the United States looks like a country that's lost a war. We got 1 million people dead of drug overdoses in the last 15 years, and we've got an industrial base that's been severely damaged, not by war, but by trade war. And if we go back to 1945, you had millions of people dead from literal war, and then you had industrial bases that were destroyed by literal war, not trade war. And so there was sort of a boom in the aftermath of World War II where the US rebuilt the world. And there were two, poles, if you will, right? The Soviets sort of built their sphere of influence, and we built our sphere of influence. And, maybe we get two spheres of influence like that again. That's entirely possible. But part of it is the US is reprising the role of Europe there. Like, we need someone to come build stuff for us because we really can't on our own. And so I think there's a goal to try to get the Japanese and the South Koreans to do it. It's gonna be really hard without the Chinese. So it's this dissonance of, well, we don't want to completely decouple from the Chinese. We just want to decouple the way we want to decouple. And some of it is just, look, the US has been left in a really bad position by really dumb decisions for 30 years by its leaders. Dumb / greedy / short-sighted. And so, like, that's, what is globalization? Now, the traditional flow of what we've done, that is, I think, absolutely dead. This sort of, hey, we send dollars and they recycle the dollars into our financial markets, so China ends up owning, providing all our defense and owning all of our stocks, wrought to its natural, in extremis conclusion. Like, I don't think like that's over. But there's still parts of the US, as we've seen in the last week. It's like, well, we want to be, sort of half pregnant. We want some of that, but not all of that. And, the reality is that you can't be half pregnant. You're either pregnant or you're not. And you're either going to connect with them or you're not, because the dollars are fungible, right? You can't say, well, those dollars are only good for this. No, not unless you put up capital controls, not unless and you can't have capital controls between the global reserve currency and the world's factory, China. Like, you put up capital controls that are too much, you're not the reserve currency anymore. And that, that to me, again, you kind of tie it back. It's like, you're going to have to net settle in gold. Maybe someday Bitcoin, but it keeps going back to the system needs to change. If we don't want the Chinese recycling into our markets, and they're not dumb enough to just buy treasuries, because we need negative real rates on treasuries. We can't afford it without, and they're not dumb enough to stockpile negative real rate treasuries, then you're going to have to do something to change the system to kind of balance those two competing needs.
Yeah, to that point about being half pregnant throughout this transition, I wonder about countries like Vietnam. Do you think they'll be able to play both sides throughout this? And also Taiwan. We haven't even talked about Taiwan yet. And obviously, there were some very fascinating FX movements that happened in Taiwan in the lead up to this. And yeah, like these type of countries that are trying to play both sides, where do you think they net out throughout this transition?
I had a meeting with somebody, once removed from one of the most highly influential people tied to tech in Southeast Asia. This is 2018 when China was smaller than when they are now and less far along, less consumption than they're doing now, et cetera. And they said, look, if you guys make us pick, we're going to have to choose China. And this is a US ally. This is a tech company and a US ally. We would have to choose China because they're just so much bigger. They're so much bigger. They're so much more growthy. The penetration rates, when you look at the per capita consumption of stuff in China versus the US, I don't know how they'll choose. I mean, I think for me, Taiwan, I don't think there's going to be any Chinese invasion of Taiwan. Why would they invade? Like, number one, the place is going to get trashed. And then that's not good for anybody. And by the way, that makes China the villain in this whole thing. And practically speaking, the Chinese have shown a willingness to be very, very patient. And if they just kind of keep increasing business ties with the mainland, then they can wake up in 10 years, 20 years, 30 years, and they maybe just regain it without firing a shot, without even having to take this sort of drastic action. So I continue to think there's not going to be a war in Taiwan. I mean, and if we were forward thinking again, as the US, we'd be like, okay, these business ties with Southeast Asia are likely to continue. Let's really do some sort of industrial policy to bring back stuff. And you've seen it certainly on the margin, but it's not been wholesale. It's been like poor man's, like pigeon industrial policy, sort of like, well, we're going to build 3 fabs in Arizona. And that's great. But like until you are subsidizing, the teaching of welders and the teaching of semiconductor engineers, like welders in this country shouldn't have to pay a dime to get educated. Semiconductor engineers in this country shouldn't have to pay a dime to get educated. Sort of the whole supply chain, so that we wake up in 10 years and go, wow, like now we can compete if we need to, if we want to, et cetera. But again, it's starting to be less anathema than it was, say, 5 years ago, 10 years ago, to do something like that. But there's still not the sense of urgency because again, the bond market, like that's not free markets. That's not what we do, which again, is just, if you step in and support the treasury market every time it starts to throw up on itself, you're not a free market. So just friggin' embrace it, do industrial policy, do what's right strategically for the country. But there's still this view like, well, we're a free market, except anytime the treasury dysfunctions, they come in and they do something. But it's still, we're not centrally planned. Well, no, you're just literally putting out fires on a centrally planned basis, which is, again, no way to run a country, a serious country at least. So, I'm kind of rambling because I don't know. Like, can Vietnam be part of a solution around China? Sure. And like, take a look at the relative sizes of the country. Take a look at the infrastructure. When you talk to people in sourcing, like, yeah, Vietnam can be part of it, but like China is 7 of the 10 biggest container ports in the world. It took China 30 years working at the fastest pace in human history to build that infrastructure. So do you think that the Vietnamese can, best case, the Vietnamese is going to take 30 years, best case. And oh, by the way, does anyone remember what happened to commodities while China was doing that? What happened to commodity inflation? Imagine what would happen to commodity inflation if you did that. Again, you go back to this elephant in the room, which is the US bond market will throw up on itself. It will dysfunction if you have something like that again. So there's just, I keep, no matter which way I talk around it, I keep coming back to the same thing, which is they're playing with their food until they do industrial policy, yield curve control, capital controls, devalue the dollar, devalue the debt to GDP, and reset the system to something where the dollar is still the reserve currency, but gold is the neutral reserve asset. Then we can compete. Otherwise, we're just, it's just like, okay, here we go again. I might as well just go to the beach for the next 3 months. Because this what are they doing?
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the #1 institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, NPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ONDO.finance, and see how they're bringing capital markets on-chain. Restrictions apply. Okay, let's dig into the situation in the bond market and the fiscal path. And just to contextualize it a little bit here is, based on some napkin math that I've seen so far, based on where the effective tariff rate is at this juncture with this new trade deal, it's around 12.5%. So 12.5% effective tariff rate. We're running a 7% of GDP fiscal deficit. And then now you have what's coming forth in terms of these major tax cuts that are coming down the pike. When you start to balance all of these together, and also Doge, which was originally saying about 2 trillion in cuts, we're now down to about 150 billion. It's basically, that's just a couple days worth of interest expense, right? So when you put that all together, what's your outlook for the fiscal path from here on out, and how does that get intersected with the bond market here?
I have not rerun the math with the tariffs where they are. I just looked at, I think they did, I don't know, like 30 billion in a month or something like last month. And I don't know sort of what that represented relative to sort of where we were and where we are. I've seen 500 or 600 billion a year in interest, or excuse me, in tariffs, maybe even 700 billion. And as best case scenarios prior to where we are today. And if you look at what the US collects from its bottom 90% of taxpayers on the individual side, it's like 675 billion. And so in sort of a perfect, vacuum, in theory, a lot of, what we were collecting on tariffs before that moved could offset Trump basically cutting income taxes to zero for like the bottom 90% of individual taxpayers. That assumes no other offsets, et cetera. And then that is also tax cut agnostic. I've not sort of run that math. That would be very stimulative, and so that's where it starts to get some of the reflexivities of that. Okay, if that's stimulative, then the economy grows faster. 10-year yields probably go up. 10-year yields go up. Like, does that restrict the economy? Does that drive a higher interest expense? So now the deficit's bigger. And it's very difficult once you get to sort of the second and third derivatives of what it could be. But just on a strictly in a vacuum basis, the tariffs, could help. It could be a huge political tool. I don't think anybody in the bottom 90% is gonna dislike, having their taxes cut significantly, maybe to zero, conceivably. Bigger picture, the deficit's, it's like you're spending. We highlighted for clients last week, we hear over and over, we're in this new Cold War, right? China, Russia. Great. Okay. Interest expense is already above, on a net basis, above defense. For the prior 85 years of U.S. history, that had never been the case. In fact, during the hottest part of the Cold War, during the Cold War, defense was never less than 4% of GDP. It's 2% today. Sorry, it's not 2%. It's actually more like 27. So it's closer to 4 today. Sorry, it's closer to 4 today. It was never less than 5 to 10 as a percent of GDP historically. And you go, all right, well, if we're in a new Cold War, the defense is going to be 6-8% of GDP. So the 7% deficit we're running today is going to have to go up another 200 to 300 basis points. So you're 9 to 10%, and that assumes interest. They're still repricing some of your interest. Entitlements are running at 70% of receipts. Receipts are running at all-time highs. Receipts are dependent on stocks going up. Stocks need to go up 10, 15, 20% a year just to basically make the fiscal math work and to drive enough receipts. So when I put it all together, I think the deficits are going higher, and I think the market's going higher because ultimately, if the market doesn't go up by 10 to 20% a year, the market being S&P 500, you're going to have deficits creating treasury market dysfunction, and then they'll come in and have to create, whatever liquidity or take whatever policy or to make sure that equities are constantly setting new records to fund the government.
Yeah, I would love to unpack further. Obviously, there's the nuclear option that you've referred to a couple times here of yield curve control, where they just outright cap the long bond at a certain rate and say, we will buy unlimited amounts of bonds to protect that rate, just like what the Bank of Japan did, what the US did after World War II. But I also want to hear a bit about what are some of these smaller levers that can be pulled in the interim before we get to that nuclear point. We've heard a lot of talk from Treasury Secretary Scott Bessent about ramping up Treasury buybacks potentially to either further alleviate liquidity constraints there. Obviously, the big issue there, like when the Treasury market really seizes up, it's those off the run bonds that are super liquid. That's what really seizes up. So trying to improve that. There's also been a lot of interest in stablecoins coming recently from the Treasury market, which is a really interesting new category of marginal buyers of US Treasury debt. So in light of this situation where we're not exporting as many treasuries to the rest of the world, what are some of these more nuanced tools in the toolkit that can be used?
Yeah, I mean, I think the Treasury buyback, Bessent's talked about that. It's interesting if you look at the price of the Treasury futures, the long bond price, from the moment I noticed this the other day, actually, for the first time since Yellen started buybacks in May of 24. It looks the futures price. It looks like there's been a floor under the price. That's a yield curve control light price action. So I think that's something they can do. B, I would argue he's already begun ramping that up, right? So since Yellen, last 11 months, the buyback program's been in place. There's a total of 169 billion that has been bought back per the latest TBAC report. Of that 169 billion, in the last 3 months, Bessent's done 75 billion. So about half of the buying in a quarter of the time. So he has accelerated the pace. It's certainly, that's fine. It's basically sort of active treasury management of, issuance, what have you. Obviously they've done a lot of things over the last 10 years between regulating banks into buying, regulating money markets into buying, regulated pensions, or incentivizing pensions into buying via tax benefits under Trump's first term in 2018. Stable coins certainly could be another form of that. Again, in the latest TBAC report, foreigners in total are buying about $30 to $40 billion a year, or a month, excuse me, of treasury bonds and notes. And in the first quarter, in the latest quarter, they bought between 180 and 200 billion a month of bills. So foreigners are still buying treasuries, just they've shifted to the front end. By way of comparison, 10 years ago in 2015, with 18 trillion in debt, as opposed to 36 and change now trillion in debt, foreigners are buying 30 to 40 billion a month of bonds and notes then. So literally we've doubled the debt, and foreigners have not increased their monthly buy rate of bonds and notes in that time. It's shifted to the front end. And I think that, speaks to your point on T-bills and stable coins. And I think it's why the US administration is so focused on them as a policy lever, which is, Bessent last week came out and said, hey, digital assets could create $2 trillion of demand for stable coin or for securities, for, T-bills. Because the reality is that it's unlikely that stablecoin issuers are going to issue a bunch of stable coins and then buy a bunch of 10 and 20 and 30-year treasury bonds. The duration mismatch is too great. So it's probably going to be mostly, if not all, T-bills. And so what you're really talking about when he says that is, a much higher price of Bitcoin, because in my opinion, you got 200 billion of stable coins, give or take. Now it's probably closer to 240 billion, but of total stable coins in the world, he's talking about 2 trillion of digital asset demand for U.S. securities potentially. That was a Treasury Department number from the TBAC supplemental report 2 weeks ago. Look, the implications of that is if he thinks you can get 2 trillion in stable coins, right now you have 240 billion in stable coins and a $2 trillion Bitcoin market cap. So if he thinks he can get 2 trillion in stable coins, to me, the implication is he thinks, you can make the case, at least. I don't know what he thinks. I don't want to put words in his mouth. His math to me suggests that you're going to need at least a 5 to 10x increase in the market cap of Bitcoin in order to drive the stable coin sort of, keep that ratio the same, right? 2 trillion in Bitcoin market cap over 200 billion in stable coins, 10x. You want 10x, you want 2 trillion of stable coins, you need 20 trillion maybe of Bitcoin. Well, that's up 10 from here. So, haircut it. Say it's only up 5x from here. Say it's only up 3x from here still. So that's the first thing is when we hear, hey, stable coins are going to fund it. Yeah, maybe. Makes me real excited, for my Bitcoin position for sure. But then secondly, let's not sell short what he's saying is we can't issue at the long end. So we're going to issue at the short end. And you're going to run $2-3 trillion deficits heavily financed in the bill markets. Like that's very inflationary over.
I want to dig into that point a little bit further, and I'm going to ask this intentionally simplistic, which is just why can't a reserve country just issue a ton of bills? Like where is the constraining factor on the idea that we're just going to, we're not going to issue any long duration. We're just going to issue 0 to 5 year basically from here on out. What is the constraining factor around that allows them to not actually do that in practice? Why is it risky to do that?
The constraining factor is inflation, and in particular, domestic inflation, right? So we can look back. Foreign central banks haven't bought any treasuries on net in 11 years. We know that. So like that's already been broached. They're not buying. They're buying gold instead. And so they're kind of looking out, to me, the read of that for the last 11 years has been the Americans can't make the math work unless unless inflation runs higher than yields, and great, just buy gold. The domestic constraint is just inflation. And so, and when you say it's just inflation, it's just the political, because the politicians really don't care about us. They just care about getting reelected. So, they didn't care about inflation at 8% in 2021. And then in 2022, when there's election, it was like, oh no, we got to get inflation down. And so that's the constraint. That's it. That's the only constraint. And so, it's going to be inflationary. The reality politically in this country is like half of the people, by virtue of our, electorate, which is very divided, depending on which color is occupying the White House, right? Red occupying the White House, then the red people are going to believe them when they tell them inflation's 3 and not 10. And the blue are going to go, oh, it's in higher, and these are inflationary policies. And then, the blue guy gets in the White House, and they're going to do the same thing. And, everyone who votes blue is going to say, oh, inflation's actually 3, it's not 10. And all the red people are like, oh, it's 10, not 3. And so it's, me, I'm sort of like I don't care either way. I'm just going to watch my Bitcoin and gold go up every year because it's 10. And yeah. I don't care what you tell me, it is what it is. Over time, they're going to go up with that. So yeah, the constraint on it is just inflation. And, at some point the bond market really revolts, but like the more you go at the short end,
a sign of the times of where macro is at right now is we've gone 45 minutes without even mentioning the Fed or Jerome Powell. But I want to bring that dynamic into the conversation now, because we're starting to talk about, okay, well, if I assume you still have the running assumption of higher than the 2% target inflation, and that is not entirely unintentional due to just how high the debt levels are relative to GDP. So obviously we had the FOMC meeting last week, and it's quite clear that they are on a full-on pause. And if we're getting a further de-escalation in terms of tariffs, that makes their job a lot easier. But yeah, how are you thinking about the Fed right now and how this sits within this entire framework that we just talked about?
I don't know, to be honest.
Same.
They're in a tough spot. They're in a tough spot, right? Because let's not mistake, we're still talking about 30% tariffs on China. Just because it was 145, there's an argument that can be made that what just happened with the de-escalation was we took absolute collapse of the economy where you would get a moment of deflation before you literally started hyperinflating as shelves went empty. You just took a very deflationary momentary impulse off the table, right? Because now we're going to get a normal flow of goods after a bit of a lag. It's just all going to be 30% more expensive from China. And everyone and their mother, even if they're, look, if you're a businessman and you're not making stuff in China, but you're competing against someone who's making stuff in China, you're an idiot if you don't raise your prices 25%. Why wouldn't you? And so I think ultimately, like, you can make the case that actually what just happened is increases the impulse to raise rates if you're looking at it as a central banker would look at it, which will be interesting if that's the correct interpretation. I suspect, we'll get about 3 days of rally here, and then everyone's going to start freaking out about the bond market again and about rate hikes again. We'll see. But again, for me, it always keeps coming back to that. Like, at the end of the day, the U.S. has a debt problem. It's the reserve currency issuer. They've got to have significantly negative real interest rates. So it's this constant, yin and yang between the Fed trying to maintain their credibility on inflation while simultaneously not being willing to be the first Fed to let a U.S. Treasury auction fail. And those are the two constraints on either side. And so those constraints are still there. They haven't changed. Right now we're, I think, kind of comfortably between the two, but let's see how that plays out over the next 3 months.
Okay, so just to wrap up this conversation here, I do want to explore a little bit around what would be the invalidation of this whole thesis you talked about, which my assumption of that would be genuine austerity from the government, going from 7% of GDP fiscal deficits to something a lot more normal. How do you discount that possibility in terms of your framework? Because as the way that you outline it, it feels quite clear and inevitable to me. And I agree with 99% of it. But how do you discount the possibility of, okay, oh crap, the society is fed up with inflation. We need actual austerity or else they're going to kick us out of Congress. How do you think about that risk?
I think it's like no risk. I mean, I watched for it, but like,
yeah,
2Q22, we did have austerity. U.S. Treasury outlays in the second quarter of 2022 were down 30% year over year. And by the third quarter of 2022, the bond market broke again. And Yellen came in and weakened the dollar dramatically. Like, for me, it's not, can they try? Of course they can try. It just won't work. And number one, it won't work. But I manage my own personal assets based on keeping a liquidity position such that the U.S. government will break before I break. That's all. All right. So, like, we've seen it third quarter 22. They did austerity second quarter 22. By third quarter 22, markets tanking, and Treasury yields are going up with a tanking market. Like, the U.S. government cannot afford that unless they are going to nominally default on their treasuries, which I ascribe a probability of 0 to. They have to do something. And they did. They weakened the dollar. Then again, in 3Q23, same kind of thing. I know it wasn't austerity, but so, like, when you look at austerity, there's only so many things they can cut. They spend, I don't know, they spend $7 trillion a year roughly. They take in $5.2 trillion of receipts, right? So right now we're looking at, $1.8 trillion deficit. Of that $7 trillion they spend, let's look at it from a receipt side. $5.2 trillion of receipts, $3.5 trillion of that right now are entitlements. Okay, so are they going to cut entitlements? There's no friggin' chance. Not like it's not going to happen. Interest right now, $1.5 trillion gross. Okay, they can cut that, but it's not going to make me feel any worse about gold, Bitcoin, and stocks. All right, and oh, by the way, if they do that, we know what happens to the bond market. We saw it in the fourth quarter last year. Bond market got killed after they cut rates. Okay. Defense in the middle of a Cold War. Remember, we're only spending 3-4% on defense. We've always spent 6 to 10 in a Cold War. Are you really going to cut defense? No. Okay, so 3.5, 1.5 trillion plus another trillion. That gets me to 6 trillion. That's $1 trillion of deficit, right? 5, 6. Yeah, that's $1 trillion of deficit on $5.2 trillion of receipts. I haven't even touched national parks, education, Veterans Affairs, which is now a $400 billion a year line item because all the stupid wars we've had. Labor, on and on, the rest of everything they spend on. So the only things they can cut that matter, they can't cut. And if they do cut, it's going to hurt the bond market. So then, to me, like, what invalidates it? Look, if if we overthrow Putin and install a Yeltsin and the Harvard boys go over there and start selling off Russia piecemeal to American oligarchs at, pennies on the dollar and only sells their resources in dollars, and then we use that to choke off China and then China tips over, like, yeah, that's going to invalidate that. Is that going to happen? No, probably not, especially since we lost in Ukraine. We couldn't even produce our own weapons enough. We got outproduced 4-1 in Ukraine, according to NATO Secretary General a couple months ago. So that's probably not going to happen. The other thing that you'd have to watch for is like some sort of, significant decline in boomer mortality or increase in boomer mortality, right? If a bunch of boomers died quickly, then your healthcare, that $3.5 trillion a year we're giving to the boomers is not only going to shrink meaningfully, but their assets are going to go to their kids, and the kids are going to spend it because they're in peak spending years. That would invalidate this, right? Anything that basically took boomer mortality up a lot quickly would invalidate this. You're not seeing that in the data. But other than that, even a productivity miracle doesn't really help you unless it arrives at just the right pace. Because if it arrives too fast, unemployment goes up, bond market's going to break again in deflation. And if it arrives too slow, it doesn't matter anyway. So, I spent a lot of time thinking and watching for things that would invalidate it. And like, in theory, a Ukraine war where Russia, the ruble actually became rubble and Russia lost, like that would have possibly, but didn't go that way.
Absolutely. All right. Well, just to wrap up this conversation here, it sounds like, despite the obviously positive trade deal announcements that came with China over the weekend, it sounds like you think the trends are still set in the same direction. There's no real change in those. There's just some on the margin, improvements, but overall it's still the same way you see the world as it stands today as it were on Friday.
Yeah, I think all from an ending point, I think, yeah, because at the end of the day, they need asset inflation to make the math work. They need negative real rates to make the math work. And, I don't think there's been a real, remember what was going to happen. We came into this year, right? We were going to doge 2 trillion and we were going to force Japan and South Korea and China to buy our debt and Europe to buy our debt. And we were going to term it out to 50 years. And, we were going to choke off China and they were going to collapse. And like none of that stuff's happened, right? We're sort of right back to where we started. And so until proven otherwise, I've got to kind of stick with what the math says is most likely to happen, which is something's going to happen to basically force a negative real rate environment more aggressively.
Awesome. Well, Luke, I can't thank you enough for joining the show. Really great to catch up with you. And where can folks go if they want to see more of your work?
Sure. Check us out, fftt-llc.com for more information about our mass market institutional research products, and obviously on X at Luke Gromen, LukeGromen. So thanks for having me back on.
Amazing. Appreciate it, Luke. All the best.
You bet. Thanks.